Hi guys, welcome to the second week video. My name is Eddie from Eddie Finance. Today I'm going to explain to you how does a credit card billing cycle works. By understanding a credit card billing cycle every month, you will eventually understand how banks and credit card company calculate your purchase interest if you do not pay your credit card in full on due date. Before we start, I just want to say massive thank you for friends, family, YouTubers out there, you guys, for supporting my first video, for the thumbs up, for the subscribing. Without you guys supporting my video, I probably won't be here again to make the second video to share the knowledge that I know about credit card. I hope you like the video. So let's get started.
In this video, I'll explain to you how does credit card billing cycle works. We'll also learn to know when is the billing cycle start, when is the billing cycle finish, and how long is your free interest days. So understanding the whole credit card billing cycle month to month, it will eventually help you avoiding paying interest on your credit card forever. So for the purpose of this video itself, we'll need to make some assumptions on the credit card itself. So we need to make assumption that you pay credit card full on each cycles, and another assumption is it's a 45 days interest free days on the credit card promotions. That 45 days literally means you have a 30-day cycle to spend on the credit card and you have a 15 days to pay. So if your credit card has a 55 days interest free days, what that literally means is you have a 30-day cycle on your credit card and you have a 25 days to pay. And if you have a 60 days, means you have a 30-day cycle, you have a 30 days to pay. So just for this video, we'll make a 45 days interest free days, which is the normal credit cards offer from the bank. It's a 19.99% purchase interest on credit card. We'll make an assumption that you always pay the credit card in full before the due date or on due date itself. And to make it simple, we also make an assumption that the billing cycle start on the 1st of January. We only discuss the purchases here. We won't discuss the balance transfer on this exercise. So this is a month period of your billing cycles. The start date is the 1st of January and you have the end date, which is the 30th of January itself. So when you have a credit card, you got a credit card approved, you went out, you spend $100 and you spend another $150. At the end of the cycle of 30 days, the credit card company will issue your statements to tell you how much you need to pay. And on the statement, if you read carefully, it'll tell you the period from where it starts, when it finishes, and also it'll tell you when the due date to pay. 45 days means another 15 days from the statement due date, which is $250 on 14th of February. You only has a free interest days if you pay your credit card between the 31st of January till the 14th of February. So that's when your billing cycle finishes and you have to pay before the due date. Okay, so if you do pay $250 in between these periods, all the purchases that you have made for that first billing cycle will be at 0% interest free. So let's continue the second billing cycle. You have another cycle start on the 31st of January, and that gives you another 30 days again to spend on your credit card. You went out again, you buy some clothes, $100, you go out for the party, you spend another $300, and also you spend another $100 again on the second billing cycles. Again, on the second month, that's when you're gonna get your statements that tells you how much you owe on the second billing cycles, and it also tells you when you need to pay. On this occasion itself, you've owed $500 to pay, and you need to pay on due date, which is the 16th of March. And again, the 45 days calculation is from the start of the cycle, the last statement cycle, until the due date to pay the credit card itself. Again, if you pay the credit card between the 2nd of March until the 16th of March, all the purchases that you made on the second billing cycle are free interest days. And your third billing cycle start again. It gives you the end of the due date. You make some purchases again, and it will tell you on this third billing cycle how much you owe and when you need to pay. If you do, just say you spend $100 here and you spend another $150 here, before the end of the statement cycle, you pay $250 credit for the credit card. What that's gonna do is on your statement number 3, it will actually show that you owe 0. If you spend $500 in here and you paid $400 in between before the statement due out, then it will give you the $100 to pay on your statement number 2 instead of $500 to pay. Okay, so that's as long as you understand how it starts, when you need to pay before the due date or on the due date itself, you will have a free interest day for every single purchases that you do. The second exercise here, we are going to make an assumption that you are not paying your credit card in full on each cycles, and we'll get to learn and understand how do banks and the companies, credit card companies, charge the interest on your purchases. Again, it's 45 days interest, 3 days on your credit card promotions, which means 30-day cycle, 15 days to pay, 19.99% purchase interest on credit card if you don't pay the credit card in full. And in this exercise, you are only paying a minimum due date itself. And some credit card company charge between 2 to 3% minimum payment required for the balance owing, or sometimes they tell you how much the minimum required if it's less than 2 to 3%. Again, we are only discussing the purchases on your credit card. We don't discuss the balance transfer, cash advance on this exercise. So again, you have 30 days billing cycle. You spend the money, $250 on your first month on the credit card. On the issue date 30th of January, it tells you how much to pay, and it tells you when you need to pay. Again, it's 15 days after the statement issue date. Your second billing start again without you noticing it the day after the first statement is out, and it gives you another 30 days for the second statement cycle. You went out and you spend the money again. So the due date is 14. And with this exercise here, we assume that you do not have the money to pay in full $250, and you only pay the minimum required on the statement, which tells you $25 to pay it by due date minimum, or you can pay $250 on due date. So you pay only minimum $25 between 31st and the 14th of February, and you'll get charged 19.99% interest on the balance that you owe. So you do not have a free interest days. In this first one, it will not tell you how much you owe or how much the purchase interest is calculated for the $250, because the credit card company or banks will assume that the customers will pay full. So when you don't pay full and your second billing cycle start and you make purchases again, it will show you on the second statement of how much the total balance you owe. So you have spent $100, $150, that's $250, you only pay $25, and you make spending again and again. On the second statement, it'll tell you statement number 1 and statement number 2 owing total together minus the payment received, and you'll calculate also the interest that you owe. In this occasion, the statement number 2 is actually back charging the interest on your statement number 1, because you do not have a free interest days on those purchases, and that interest will show on your statement number 2. And also the billing cycle number 2, because you do not have a free interest days anymore, it will also show together as an interest purchase on the credit card. So don't get surprised if you don't see anything because you don't pay full. The banks or the credit company assume that every customer will pay full. If you don't pay full, that's when you're going to show on your statement there, on the second statement or the statement after. And the third billing cycle start again, which is another 30 days. and it tells you, sorry, on the second statement it tells you when you need to pay, which is 15 days later after the statement is issued. Third billing cycle, you went out, you spend the money again, and you do not pay full, you only pay a minimum of 3%, and on the balances that you owe on the second statement. And again, you don't have any more free interest. Every single purchase that you have, the 19.99% per annum interest will show on the third statement again. So statement number 3, it'll tell you the balance you owe for statement 1, 2, and 3. Statement 1, 2, and 3. And all the interests that you owe as well. That's all we have time for today, guys. I hope you guys like the video, enjoy and understand how does the credit card billing cycle works. So you can go out, spend the money, make the most use of the credit card without worrying have to pay any single cents on those purchase interest on your credit card. If you are one of the person that having trouble paying off the credit card, maybe you should consider using or take the benefit of doing a balance transfer on the credit card. If you don't know what is a balance transfer, I made another video separately on balance transfer. I'll leave the link below for you to click on that. And thank you for watching. I hope you like this video. Don't forget to subscribe to more upcoming videos to support myself. Hit the like buttons and also share with your friends and family that you know will beneficial from this video. Thank you guys. Ciao.